Taxation. I am Rebecca R. McKilling, your discussant. Okay, so what is income? Income, in a broad sense, means all wealth which flows into the taxpayer other than as a mere return on capital. It means accession to wealth, gain, or flow of wealth. So income may be defined as the amount of money coming to a person or corporation within a specified time, whether as payment for services, interest, or profit from investment. We have two types of income. So we have taxable and non-taxable income. For taxable income, we have compensation income, business income, gains from dealings in property, the passive income, and the other taxable income. The other hand, for non-taxable income, we have the life insurance proceeds, the return of premium, the gifts, the bequests and devices, the compensation for injuries, retirement benefits, and other non-taxable income. So we will discuss now more on the taxable income. Later, we will have another video for the non-taxable income. Okay, so let's proceed. Let us differentiate capital and income. Capital is the money or wealth needed to produce the goods and services. So all business must have capital in order to purchase the asset, maintain their operation. So this is your wealth or your initial money or initial capital that you put it on your business. On the other hand, income is a flow of services rendered by that capital by the payment of money from it or any other benefit rendered by a fund of capital in relation to such fund through a period of time. So it is the fruit of your capital. So capital is wealth, while income is the service of wealth. Or the other way, capital is a tree, while income is the fruit. Okay. What are the sources of income? So as a taxpayer, we have the individual taxpayer and we have also the corporate taxpayer. So we have several sources of income. This refers to something that provide a regular supply of money. So the source from which individual obtain income. So examples of main sources of income are the following. Earned income or compensation income, which is an income from working a job. Profit income, this is the income from business profits. Interest income, this is the income from bonds, lending, or your bank deposit. Rental income, which is income from renting out property. Capital gains, this is your income from investment profits. Dividend income, income from profit distribution. And we have also the royalty income, which is the income from publishing a book, YouTube videos, and etc. Our sources of income may be coming from within the Philippines or without the Philippines or outside from the Philippines. It is not difficult to identify whether your sources is within and without if you are purely deriving your income within and if you are purely deriving your income from outside the Philippines. But what if the sources are partly within and partly without the Philippines? So there is combination. So first you need to determine if the ratio is between 50% to 85%, you will this is partly within and partly without. So only those income who have ratio less than 50%, those income are purely without. So example, income from airline, transportation, and other services rendered within and partly without the Philippines. So our computation here is equal to taxable income times the gross receipts within divided by the total gross receipts within and without. So that is your income within. So what is this? The gross receipts, we can identify these gross receipts. Anything that you receive, no? That's your gross receipts. But how about this taxable income? So let us first define the taxable income. So taxable income, this is a tax concept, no, referred to as the gross income under the National Internal Revenue Code. So a taxable item is referred to as the items of gross income or inclusion in your gross income. So when we say taxable income means the pertinent items of gross income specified in the NIRC less the deduction. So authorized by such types of income by the NIRC or other special laws. So simply stated that if you earn money for goods or services, you have to pay tax on the value of what you have received as taxable income unless the NIRC specifically outline a type of income as non-taxable income. Okay. So what are the requisites for income to be taxable? First, there must be a gain or profit. So that would be considered as income. And the gain must be realized or received. The gain must not be excluded by law or treaty from taxation. The Philippine law on income tax allows the exclusion because there are some exclusion of some income from taxation. So it must not be excluded. That is part of your taxable income. Okay, when is income considered received? So we have actual receipt and the constructive receipt. When we say actual receipt, there is physical possession. So you receive it. This is arm's length transaction. So you receive something, you pay something like that. So that's actual receipt. While constructive receipt, it does not require physical possession but have the ability to control or utilize the funds without any restrictions. So, the income accruing to the person is already segregated for his or her favor and can be withdrawn anytime. So example here is partners' distributive share in profits of general professional partnership is regarded as received by the partner although not yet distributed. So that is constructive receipt and that's still part of the income. So we need first to understand some classification of taxable income. So first taxable income here is the compensation income. So when we say compensation income, these are all remuneration for services performed by an employees for their employer under the employer-employee relationship, unless expressly excluded in the tax code, like the compensation income of minimum wage earners in private sectors and compensation income for employees in public sector with salary does not exceed the statutory wages. So they are exempted from tax. So if they are minimum wage earners. But for those who are not minimum wage earners, of course, this is part of the taxable income. So the following are included as part of the gross compensation income. Letter A, the salaries, wages, and fees. Salary is generally an earning paid on regular interval. So the wages may be paid on hourly or daily basis. So again, if you have minimum wage earner, if you are earning minimum, so you are not taxable. So other is, on the other hand, fee that is payment to an individual in authority, like the director's fee, legal fee, accountant's fee, and etc. So, if director is not an employee of the company, the fee shall fall under the classification of income derived from conduct of trade or business or exercise of profession and shall subject to withholding tax. These are the fees, specific or with professional fees. So, they are subject to withholding tax. So, for individual, 5% if the gross income is 3 million and below. And 10% if it is exceeding. So you will have this 10 withholding tax. So the company or the individual will withhold if there is this accountant fee, legal fee, attorney's fee, and then they hire not employed in the company or in the individual business. So you will have withhold 5% and 10% for professional fees to individual. But if it is companies, 10% if the gross income is 720K and below 1.5% if exceeding 720,000. Okay. Part of compensation income is also commission. So payment made based on certain percentage of sales output like the salesman commission, it is taxable even if the employee is receiving a minimum wage earner. So it's really taxable. So it would be part of his compensation income, the commission income. Okay, still part of the gross compensation income. Honoraria, these are earnings derived from services usually undertaken by a person with expertise in a particular field. So honoraria is given to a special lecturer, so it is also taxable regardless if taxpayer is a minimum wage earner because this is add-on, no, additional income to the taxpayer. Allowance, it may be either fixed or variable. It is considered fixed if the amount is set and did not vary and is attached to the position, and is variable when it changes accordingly by a certain factors. So still part of your gross compensation income. So what are the most common types of allowance? So we have the COLA, the cost of living allowance. This is not part of the basic salary, and this is not also taxable. We have also the RATA. RATA is granted to the public officers and government employee and subject, or if it's subject for liquidation, but generally this is not taxable. If it is subject for liquidation, this allowance is taxable if received regularly by employee and shall form part of the compensation income. So again, if subject for liquidation, allowance is taxable, but if not, it is not taxable. We have also the PERA, the Personnel Economic Relief Allowance. This type of allowance is non-taxable if received by the government employees. Okay, 13-month pay. It is equivalent to the mandatory one basic salary of employees. This is computed by dividing the total basic salary during the year by 12 months. So other benefits here include Christmas bonus, productivity incentive bonus, loyalty awards, gifts in cash or in kind, and other benefits of similar nature. They are not subject to tax for a maximum of 90,000. Otherwise stated, in excess of it, it is taxable. So, malampas na sa 90,000, taxable na yan. Next, holiday, overtime, night shift, differential and hazard or emergency pay, generally taxable yan except if it is earned by a minimum wage earner. Separation fee or separation pay. There are cases that it is taxable and not taxable. It is not taxable if made because of valid, or there are reasons, no? For example, on account of sickness, there is disability, there is death, there is reorganization and bankruptcy of the company. They are not taxable. Next, retirement pay. As a general rule, it is taxable except if retirement pay from SSS and GSIS. So retirement pay from employer and retirement plan has been approved by the BIR Commissioner, and the retiree should have been connected within the company for 10 years and at least 50 years and is availed for the first time. They are not also taxable. So only those retirement pay from SSS, GSIS, and from approved by the BIR Commissioner. So, they are not taxable. Other than that, they are magiging taxable na if hindi siya na-meet yung mga requirement na ito. Okay, next. Sick leave pay or vacation pay. Generally, they are taxable except the cash value of unused days, 10 days or less, which was paid by the employee. Yung 10 days or below na binibigay ng company, they are not taxable. Pero generally, taxable yan, ha? So, meaning kung lampas na ng 10 days, so, the excess of it, taxable na yon, no? Next, fringe benefit. Any goods, services, or other benefit granted in cash or in kind by an employer to rank and file employees becomes part of compensation income and is taxable. However, employees occupying supervisory or managerial position, the fringe benefit is subject to final tax. So take note of it. If it is rank or file, part of the compensation income and is taxable. But if you are supervisor or in managerial position, subject for final tax ang fringe benefit. Okay. Next classification of taxable income. income derived from conduct of trade or business or exercise of the profession. So these are the business income from any trade or business, legal or illegal, and whether registered or unregistered. While professional income are earnings from exercise or practice of profession. However, the following shall not be included in gross income subject to regular income tax. So, ano ba yung mga hindi included, no? We have the business income, which is exempt from income tax, business income subject to special tax regime, and business income subject to final tax. They are not included as part of the regular income tax. So, those three. Okay, next. Okay, gains derived from dealings in property. These arise from sale or exchange of real or personal property. So the basic guideline is that any gain on disposal or sale of ordinary or capital asset is taxable and any loss incurred is deductible. But first, you need to classify, whether is it an ordinary asset or is it a capital asset, because there are rules, especially on the capital asset. So what are these ordinary assets? So it refers to properties that are used by the business in its operating activities. So they are referred to any property enumerated as follows. So stock in trade of the taxpayer or other property of a kind that would properly be included in the inventory of taxpayer. Property used in trade or business which is subject for depreciation. This is an ordinary asset. Real property used in trade or business. This is an ordinary asset if it is used in business. How about the capital asset? These are the properties held by the taxpayer, whether or not connected to business, which are not classified as ordinary asset. So later, we will have some examples on how to identify ordinary and capital asset. So in dealing with the ordinary asset, this is subject to regular income tax and also for capital asset. But not on domestic stock and real properties, because domestic stock, they are subject for capital gain tax, and also the real property, they are subject for cap gain tax. So other than that, they are subject for regular income tax. Okay. So how would you determine the gain or loss in dealing with your property? So you have your selling price. This is the sum of money received and the fair value of your non-cash property received, less the tax basis or the adjusted basis of the asset disposed. That is your gain or loss. The tax basis is either the cost, the carrying amount, or the depreciable asset or cost of the asset. So selling price less the tax base. If it is above, if it is positive, there is a gain. If it is negative, there is a loss. Treatment of ordinary and capital gains and losses. For the ordinary gains and losses, they are taxable in full and deductible in full. But for capital gains and losses, in computing for the net capital gain, in every year you need to compute it by subtracting the loss with the gain. And if it is a gain or net capital gain, this is subject for regular income tax. But for net capital loss, this is not an item of deduction against the gross income. It could be carried over for the next year, for the following year, but it is strictly for 1 year only and is only applicable for individual taxpayers. For corporate taxpayers, they are not allowed under the NIRC to carry over net capital loss. And then, there is no capital loss carryover when the taxpayer incurs a net operating loss in the period. The net capital loss was sustained, and when the following year results to a net capital loss. So how we will do it? Determination of net capital gain or net capital loss. So, individual taxpayer have holding period rule. If it's not more than 1 year, so it's a short-term holding period, so 100% of the capital gain or loss is recognized. If it's more than 1 year or long-term holding period, so only add or deduct only 50% of the capital gain or loss. So our illustration, Mr. Lee sold various properties on the following during 2019. So take note of the date acquired and the date sold. So that would be your holding period. So if it is 1 year or below, 100% of it. If it's more than a year, so you will only compute 50% of it. So you will also classify whether it's an ordinary asset or a capital asset, since you will not deduct the losses on the net capital losses on the operating income. So you need to classify the ordinary and the capital asset. So from here, our ordinary asset is office supplies, while car, laptop, home appliance, the books, and the vacant lot are capital asset. However, for the vacant lot, this is subject for capital gain tax, which is 6%. So you need not to classify this one in your taxable income, which is subject for the progressive rate. It is individual taxpayer. But this is individual, so you do not classify the vacant lot. So only the car, the laptop, the home appliance, and the books. And then you need to identify the holding period. So for car, it's from August down 2017 to 2019, so it's more than a year. It's 50% of it. Laptop, it's 1 year, so you may use the 100%. Home appliance, it's it's more than a year, right? More than a year. 721, yeah, it's more than a year. So you need to compute the 50% of it. Well, the books, it's mm, not I not less less than a year. So let us less than a year, 100%. So our 100% here is the laptop and the books, while car and home office is 50%. So again, our car is 50% and a home appliance is 50%, laptop and books 100% short term. So you compute the net capital gain here is 20,000. Take note, vacant lot is sale of real property subject for 6%, whichever is higher. No? Okay, that's it. Again, for corporate taxpayers, the capital gains and the losses. You will recognize it 100%. Now, let's go to the citus on dealings and properties. So, if taxable and world income, rules of dealings and properties apply to all properties regardless of location, especially those who are resident citizen. If taxable only in the Philippines, Philippine income, the rules of dealings in properties will be applied only to the properties located in the Philippines. So you need to classify whether the properties are within and without. Then you can already compute your taxable income. So our example is Lee Minho, a Filipino citizen. Since he is a Filipino citizen, he is taxable within and without in the Philippines. All the properties within and without. So we have the following gains and losses now of ordinary assets and capital assets. So we are computing for the ordinary gains and losses now from our example here. So you just classify what are those within ordinary gains and ordinary losses. So our ordinary gains within 120, without 300. So for the world is 420. Our ordinary losses within is 40, without is 80. The world is 120. So if you minus or deduct the losses from the ordinary gains, so we have 300,000 as our net operating income or net gain. So again, you need to classify the ordinary asset and the capital asset, as well as the properties within and the properties without, because there are taxpayers that they were only taxable within the Philippines, especially those who are non-resident alien, not engaging business, or non-resident alien engaging business in the Philippines. Okay, so you need to classify it. Now, for net capital loss carryover, it is only allowed to individual taxpayer as a deduction against the net capital gain of the following year, subject to the following limits. We know that the net capital loss carryover can only be applied 1 year. After the 1 year, after the lapse of 1 year, so it cannot be applied. But there are limits. Limit 1, the amount of net income the year the net capital loss was sustained. Limit 2, the available net capital gain on the following year. So whichever lower in that limit, that's the only losses that you can carry over. So this is only for 1 year and does not apply to corporate taxpayers. So let's have an example. Hannah reported the following in 2018 and 2019. So we have the ordinary business income. We have also interest on time deposit with PNB, short-term capital gain, capital loss, and long-term capital loss. And you need to compute the taxable income in 2018 and 2019. So again, the gain and losses, if there is net capital loss, you will not deduct it on the operating income. So let's look on the solution. Okay, so this is our computation. So ordinary business income, 56,700 for 2018. For 2019, 60,800. The interest income is excluded since this is subject for final tax. So again, you classify the short-term and the long-term capital gain and losses since short-term is deductible in full and recognized as full. It is short-term for capital gain. But for losses, you have your holding period, so 50% of it. But take note of the rule, if there is net capital loss, it could not be deducted to your ordinary business income. So in 2018, we have a net capital loss of 3,400. This will not be deducted in your ordinary business income, but it could be carried over in the next year. However, there are certain limitations. Limit 1, the net income where the capital loss is sustained. So in 2018, 56,700 is our net taxable income, which is very high. And also our losses, okay, for the net capital gain the next year. So our net capital gain, we have 8.2, so we can deduct it, because it is lower. There, you can deduct it there. So 3.4. So our taxable income in 2019 is 65,600.